So, if you're into business or investing at all, you've seen it everywhere, the P/E ratio. It's probably one of the most common numbers in all of finance. But what is it actually telling us? What does it really mean? Well, let's figure that out together.
Okay, let's just jump right in with a puzzle. As of right now, investors are willing to pay a whopping $164 for just one single dollar of Tesla's profit. But for a giant, stable bank like JP Morgan, only about $12. Think about that. Why on earth would someone pay over 13 times more for a dollar of Tesla's earnings than they would for JP Morgan's? What is going on there?
Well, the answer to that huge valuation gap, the key to understanding what the market is truly thinking, it's all wrapped up in that one simple metric, the P/E ratio.
All right, so let's get into the nitty-gritty. Let's really decode this thing. What exactly is the price-to-earnings ratio?
You know, at its heart, it's actually a really simple calculation. You just take a company's current stock price and you divide it by its earnings per share. That number you get, that's the P/E ratio. And it's basically the price tag the market is slapping on $1 of that company's profits.
Now, there are a couple of really intuitive ways to think about this. The first is as a kind of payback period. So if a stock has a P/E of, say, 20, that means it would theoretically take 20 years for the company's current earnings to add up to the price you paid for one share. The second way, and this is probably the more common one, is to think of it as a multiple. A P/E of 20 just means you are paying $20 for every $1 of that company's yearly profit. Simple as that.
Okay, but here is the single most important rule about the P/E ratio, and you have to remember this. That number, all by itself, is pretty much meaningless. It tells you almost nothing about whether a stock is a good buy or a bad buy without some context.
So, generally speaking, a high P/E ratio tells you investors are feeling really optimistic. They're expecting huge growth in the future, and they're willing to pay a big premium for it today. Of course, it could also just mean the stock is way overvalued. On the flip side, a low P/E suggests the opposite. The market expects slower growth, or maybe it sees more risk, and this could be pessimism, or it could be a clue that a stock is a potential bargain.
And this is exactly why the P/E ratio's real power comes from comparison. You can't just look at the number. You've got to ask some questions. How does this P/E look compared to where the company has traded in the past? How does it stack up against its direct competitors, its peers in the same industry? And what about against the wider market, like the S&P 500? And that industry context, man, it is everything. I mean, just look at this. A P/E of 35 might be totally normal for a fast-growing tech company, but that same number would be absolutely astronomical for a big, stable bank, where something around 12 is much closer to the average. You have to compare apples to apples.
Okay, so that's the theory. Let's put it into practice. Let's see how this whole P/E thing actually plays out in the real world with some of the biggest, most well-known companies out there.
So we went ahead and pulled the P/E ratios over the last decade for the 20 biggest companies in the S&P 500. And this is where the story really starts to come into focus. This table really brings it all together. Look right at the top. There's our friend Tesla with that sky-high P/E of 164. That's the market screaming that it expects absolutely massive growth. Now let your eyes drift down to the bottom. There's JP Morgan. Its P/E is just over 12, totally normal for a giant bank. And then check out Procter & Gamble, right in the middle. Its current P/E of 25 is almost identical to its 10-year average. What does that tell you? Stability. Every single one of these numbers is telling a different story.
But you know what? There's a really fascinating trend kind of hidden in that last table. If you look again at that last column, the lowest P/E year for the big tech companies like Meta, for a lot of them, that year was 2022. So why then? Well, that's when interest rates suddenly shot up, and that just hammered high-growth stocks. The market basically had to reprice its expectations for the entire tech sector, almost overnight.
And that repricing in tech, it creates these huge ripple effects. Why? Well, just look at this chart. Tech companies make up a dominant 40% of the market's biggest players. So when their valuations get reset, you better believe the entire market feels it.
Which brings us to what I think is the real secret of the P/E ratio. It was never meant to be an answer machine. It's really a question machine. Its job is to make you ask, Why?
You know, the source material for this whole explainer just puts it perfectly. It says, its true analytical power is unlocked when used in a comparative context. It is the starting point for your research, not the finish line.
So, what's the big takeaway here? First, the PE ratio is not a final judgment. It's a starting point. Second, it's a really powerful window into what the market is feeling, its hopes and its fears about the future. And finally, its meaning completely depends on context, the industry, the economy, the company's own history. It's just one tool in the toolbox, but it's an incredibly powerful one when you know how to use it right.
So from now on, when you see a PE ratio, try not to ask, is that good or bad? Instead, ask the much, much better question, what story is the market trying to tell me right now? Because that's where you'll find the real insight.